We are 2 months into 2025, and at this point, the healthcare space is the number one sector as a whole, followed by consumer staples, followed by financials. And as expected, technology is giving up some of the gains it's had over the years, and it's still a booming sector. But what I thought we could do is healthcare has been left behind for 2.5 years. Some companies have been really oversold, in my opinion, from a value investor perspective, sold well below their intrinsic value. So what I did is I said, okay, now let me put some analysis into looking at this sector. So what I did was I looked into all the companies that are in the healthcare space, and I did a stock screener. And what I basically did was get to, like, if you look at all the companies in healthcare, here they are. But what I wanted to do was say, okay, well, not all companies are put together equally. So I looked at free cash flow yield. The value of a company is the present value of all the free cash flows it's going to return to investors in the form of buybacks, dividends, acquisitions, cash on the balance sheet, and so forth. So this is like the number one column. But I also want profit, and I want a reasonable forward PE. So all those things were kind of the qualifier for these companies. And I went from roughly over 1,000 companies to 19. This is like, this is like the Olympics. This is the finalists from all the different countries coming together. These are the finalists. And when we look at the companies, near the top of the list, Oscar Health. We've been looking at that company. Well, no big accident. That really ranked well high. And I didn't insert these companies. I just, let the data kind of take me where it took me. I found this company, which I'd like to show you. I've never analyzed this company, but it's Collegium Pharmaceutical. And every company I looked in stock analysis and gave them kind of a quick qualifying kind of review. Like, is this even worth talking about? And this one looked really good, but it's small. It's less than $1 billion. Harmony Bio, this one, it was already a stock that I'd analyzed, already an investor. I bought in, I sold, the stock went up 20%. So I'm like, oh no, why didn't I stick to it? But the fundamentals look great. Novartis, a big stock, big cap stock. It still has really good fundamentals. So that looked interesting. United Therapeutics, Humana. This one also caught my attention. It's like Halozyme Therapeutics. And then Excelsis. These companies are going to kill me. That looked really interesting from a fundamental perspective. So I highlighted these because I'd never heard of these companies. And how I found Catalyst, which has been a super winner for me, is exactly this process that I'm taking you guys through, is looking at what's working in the market, look at the sector, let kind of analysis take me to a list of stocks and start analyzing, see which one looks better than the rest of the field. And then this guy here, Eli Lilly, even though it's a monster of a market cap, very good fundamentals. I don't think it's good as some of these up here, but I thought I'd leave it on the list. Novo Nordisk, look good. Revenue growth looks good. PE is reasonable for a very well-known name, and so forth. So let's take a look at these highlighted in yellow just to see what these companies have to offer. And this is less than $1 billion in market cap. And revenue is $631 million. So you're paying less than 2 times revenue for this company. That's a very good price. They're making money. Okay. You're making money and I'm paying for less than 2 times sales for the company. Forward PE of 4. Man, that's like make-believe numbers. Collegium Pharmaceutical is a specialty pharmaceutical company engages in the development and commercialization of medicines for pain management. Its portfolio includes Xtampza ER, an abuse deterrent, extended release and oral formulation of oxycodone for the management of pain severe enough to require daily, around-the-clock, long-term opioid treatment. Now, that got a lot of companies into a lot of trouble. So these guys have to be careful. But it did make, I forgot the name of the company. They got in a lot of trouble. Now, I think that's primarily the reason why investors are kind of staying away from this. Like, oh, oxycodone, this is kind of scary. I don't want to end up, where the other companies that had to pay off billions and people died and so forth. But this company popped up. Revenue growth is, it's growing well, and they're very profitable. So I think being an opiate company is going to deter me from probably wanting to be an investor. I'd always be afraid that, hey, these guys are going to be the next company to be sued, class action lawsuit and stuff. But man, this company is making a lot of money. Gross margins is 86%, profit margin 11%, and then free cash flow at 32%. So that was in there. That was interesting. Now, the next best company is HALO. Halozyme Therapeutics, a biopharmaceutical company, researches, develops, and commercializes proprietary enzymes, devices in the US and internationally. The products are based on patented recombinant human. So they're in the biologics space. Okay. And $7.28 billion market cap. You're paying 7 times revenue. Forward P of 12. Revenue looks fantastic at 22%. And in the last quarter, it grew at 29%. That looks tremendous. That looks good. All right. So when we look at free cash flow, look at this cash flow growth. Real smooth data. Went from negative to positive, and then from 52 to 3 to close to 4 to 468. Yeah, I'm believing that cash flow. So this one here, if I were to pay 30 times cash flow, I'd get to like 12 billion. So this one looks interesting. Let me make sure that the debt isn't a problem. They have roughly about $1 billion of debt. So that one looks interesting. Cool. So this one here, I'm going to analyze further and see if it's a good investment. And getting back to the list, so there's this one's kind of, I don't like the fact that they're into opiates. This one looks good, and then this one here, EXEL. So this one is an oncology company focused on discovery, development, commercialization of new medicines for difficult to treat cancers in the US. Okay, cool. And their stock price, I forgot to check the other one, but this one here has just been really on a roll, up 78%. Almost an $11 billion company. You're paying 5 times revenue. PE, forward P is 19. Doesn't look too bad. Now the stock's really run up. 18% growth rate for the year, and the quarter is about the same. So that looks good. And then we've got free cash flow of $671 million. So the revenue looks really good. If I multiply this times 30, I get to 18 to $20 billion of value. The company's priced at 11. So this one, the price has really gone up, but I think it's because investors are realizing it's a good business, and they have almost $1 billion of cash on the balance sheet. So we have been in an expensive market, but this exercise kind of shows me that healthcare space still has some really good stocks. This one's working really nicely, Catalyst Pharma, and some others I think are going to work really well in 2025. And this is where I'm going to be spending more of my analytical time, and I'm going to be deploying capital. Let me stop there and take any questions. Go for it, Scott.
Oh, good timing. Yeah, I'm just going to say I think you're on the right track. Just a quick note, being a Novartis shareholder myself, they have a pretty nice dividend. And you will lose some to withholding tax if you're not living here. But I think it's not that bad if you're in the US. And their full dividend is, I think, 3.5% yield. I mean, they're doing well. So, in fact, I think they are the biggest pharmaceutical company fully outside the US.
Yeah, 3.5% dividend. That's good looking dividend.
Yeah, I think it's 15% tax if you're living in the US, but don't quote me on that. You have to check.
Yeah. And over the 1 year, it's up a little bit. 5 year, it hasn't broken any records, this is what's amazing to me is you got a company that is a 13 PE for a very well-known name. You got growth rate of 11% on a very big number, and it gets a P of 13. It's like, what is wrong with this situation? If this was like tech, like big, well-known tech, this would be a PE of 30. But no, it's just a really good pharmaceutical company. Gross margins are great. Free cash flow margin is stupendous. So this looks like a really good stock.
Yeah, as far as I could tell, part of the reason for the I don't know, the limited growth is the they're running into some patent cliffs, if you know what I mean, on some products this year. But I personally wouldn't worry so much about that. I mean, you know my opinion of the company.
And you know what they can do? With bigger pharmaceutical companies, they have a big advantage. I just want to check their balance sheet real quick. So they have 18 billion in net debt. So what they can do, I'm sure they're doing this, is we should acquire this company. We should acquire this company. We should acquire this company, right? We should acquire Lantheus Holdings. We can add this much revenue to our top line. Their patents will not expire for 10, 20 years. So they go on an acquisition run now that stock prices are really low in healthcare. So that's how they could grow. So that is the healthcare space. I will kind of keep it a little bit light, just kind of share with you where my head's at. I will show you some valuations really quick on Catalyst. Actually, I have Harmony and then Catalyst. So,
oh, Victor, I should mention United Therapeutics, man. That could also be a decent buying opportunity. I mean, for me, I've already invested so much in it that I did buy a little bit of the dip, but like I was already pretty heavy into it. But yeah, that recent pullback.
So this stock here, when you look at Harmony, it just their cash flows are really good. Earnings per share is great. Very low PE. My analysis is it's trading 60% below what I think is the value of the company. And when we look at Lantheus, 39% below. Catalyst, 77% below, even though the stock's really been moving, because if you look at their last earnings, they actually exceeded on the cash that they generated. HIMSS, I did a video on it. They're not discounted. They're sold at a premium. United Therapeutics is 87% below its intrinsic value. So this is going to be a place that I'm going to deploy capital. I don't have enough invested in healthcare just because it had been underperforming. So I built up some cash, and it's going to be probably mostly focused in healthcare for the next month. In the month of March, I'll be on a buying spree within healthcare, buying more United Therapeutics, buying into CVS, Elevance, and probably adding one of the stocks that I'm beginning to look at potentially, or maybe even buying back into Lantheus, which I thought was a good buy. I guess I was right, but then I sold it. Don't you love it when that happens? All right, perfect. So let's take a look at these stocks that Tomas wanted to look at, PAMP. So Pampa Energia.
It's the second one.
Okay, so operates an integrated power company in Argentina. The company operates through electricity generation, oil and gas, petrochemicals, holding it in other business segments. It generates electricity through thermal plants, hydroelectric plants, wind farms. Okay. Got it. Market cap of 4.8 billion. This is US dollars. Revenue is 2.7 billion. Okay. Forward P is rational at 11.5. It's been going up really nicely for the 1 year, but it's really come down over the, well, not really come down. It's just come down year to date. It's down 12.6. Okay. And then over the 5 year, wow, look at that. Okay. So, wow. Do you happen to know why did they grow so much? Did they acquire another business, or?
They are expanding along Argentina with energy distribution, and they're starting to exploit more gas and oil places in Argentina.
Mm-hmm. Explosive growth. Okay, so the ARS. Okay. No. This is going to be in US dollars.
Yeah, that one is in US dollars.
Cash, debt. So a little bit of debt. So they're burning cash right now. I mean, they're growing really fast. Debt to EBITDA is okay. Margins, it's a utility. That makes sense. So this one, I mean, it's the stock is really performing. It's going up in value, going up in price, excuse me. So since you are in Argentina, I would say try to get as knowledgeable on this company as you can. This pullback, and understand, what's going to be their long-term growth. And this one's going to be hard because I don't know how to put this in a model. I don't know how to forecast it because the revenue really
So
exploded.
maybe I think you know better, but where should I look in an oil and gas company?
We'll start with I would start here. So here's an investor day. And just read all the stuff that's coming out. Like their credit rating was improved. Okay, that's good. So I would go listen to their earnings calls. So let's see if we can look at their history, see if they talk about any of the acquisitions that have happened. So here's commissioning of a combined cycle at Ensenada Barragan thermal power plant. Yeah, this one's tricky. This one's going to be more of a knowledge and information advantage. If you think, man, these guys are going to double, triple their current capacity because they're going to open 3 plants in these regions. The country needs the power. Okay, that could give you a very optimistic path for the company that, hey, they're going to really grow. But you need to get a very good comfort level in their growth. And once you have a growth, it's hard to forecast their numbers because they change so much. It's like, well, what should we use as a growth rate on revenue? Oh man, that one's hard. And then their free cash flow is negative, but maybe if we go to the quarterly, see if the most recent quarter, the quarter just went positive. So this one, I would slow down, like maybe I get another quarter or 2 quarters of financials, and then look at the financials. And if they start growing their revenue, maybe at that point you can put together a forecast and then put a valuation on the company. This one's tricky.
All right. Yes, it's difficult. This is one of the first companies I bought 5-6 years ago, and I never knew when to buy because it's always going up. And now finally it went down nicely, and I was thinking, well, maybe it's an opportunity or it's a trap. I don't know. I have to look deeper into this.
Yeah, it did great over the last 5 years, 546. And it is kind of inflation protected because they're going to charge, if inflation goes up 10%, that means in a year they're going to charge 10% more for their power. That's just the way things are going to be. All right. Well, good luck with Pampa Energia.